Europe is a massive consumer of energy. It imports vast quantities of oil, natural gas, yet its vulnerability to price shocks is not always tied to being the world's largest buyer of crude oil. A disturbance in a distant corner of the global energy market can send prices soaring in European cities. This happens even when the physical barrels of oil involved never intended to land at a European port. The real story lies deeper within the complex and interconnected markets for refined fuels, the ships that carry them, the razor-thin margins that dictate where those ships sail. Understanding this vulnerability requires looking past the headline price of crude. It means examining the entire supply chain. The global energy system is a web of dependencies. Crude oil itself does not power the economy. Refined products do. Trucks run on diesel. Airplanes fly on jet fuel. Homes are heated with heating oil. These fuels are produced by refineries processing raw crude. The markets for refined products are distinct from crude oil. They have their own supply and demand dynamics, logistical challenges, and price structures. A shortage of diesel is not the same as a shortage of crude. Often, the bottleneck is not the oil fields. It's the refining capacity that turns crude into products. Europe depends heavily on refined fuel markets. This distinction is critical to Europe's vulnerability. Europe runs on a steady diet of diesel and jet fuel. Trucking, agriculture, construction and airports all rely on it. When these product prices spike, effects are immediate. Transport costs rise, food production costs increase, and airline ticket prices go up. Refined fuels like crude oil travel the world on massive tankers. Freight, the cost of hiring these ships, is a big part of the final price. Freight rates are not static. They fluctuate with vessel supply and demand. They change with fuel costs for the ships themselves, and they move with the perceived risk of a given route. When a key shipping lane becomes dangerous, the cost of passage skyrockets. That extra cost gets passed on to the importer. Europe sits at the end of long global supply chains and is highly exposed. Imagine conflict near a choke point like the Red Sea and the Suez Canal. That canal is a vital artery for trade with Asia. It links to the Middle East, and it feeds Europe. If ships face threats there, ship owners react immediately. They may divert around the entire continent of Africa. That can add about 2 weeks to the voyage and add thousands of miles. The longer route burns more fuel, requires more crew time, and keeps vessels tied up longer, reducing ship supply. So freight rates for many voyages can rise. Refineries are not charities. They are businesses driven by profit margins. A refinery's profit comes from the difference between the crude it buys and the revenue from products it sells. The crack spread. Refineries naturally sell to the highest bidder. Barrels of diesel or jet fuel have no predetermined destination. They flow to wherever the money is best, and that is not always Europe. Imagine a large, modern refinery in the Persian Gulf. It produces diesel every day. Potential customers: Europe, Africa, Asia. If demand surges in India or China, the operator has a clear incentive. They will sell to the buyer willing to pay more. It's a rational business decision. Europe may be a traditional customer, but when bids rise elsewhere, Europe is left with a hole in an expected supply. That hole must be filled from elsewhere. Competition can be intense and volatile. Booming Asian growth lifts diesel demand. Asian buyers may pay a premium to secure fuel, pulling barrels from the Atlantic. European prices must rise to keep barrels or attract new ones from the United States. The price in Rotterdam is linked to demand in Mumbai. Shocks happen quickly. Traders monitor in real time. Cargoes can be diverted at sea for a better price, adding uncertainty for importers. In response to risks from long, vulnerable supply chains, European energy buyers are increasingly looking westward. They are shifting toward the Atlantic basin, more barrels from the United States, with crude and products also from West Africa. It's a strategic pivot to geopolitical and economic realities, a calculated move to shorten supply lines, avoid choke points, and partner with reliable, compliant suppliers. The United States has emerged as a powerhouse exporter of high-quality diesel and jet fuel, crucial for Europe. Houston to Rotterdam is shorter, burns less fuel, and cuts insurance versus routes through the Red Sea and Hormuz. Clear, verifiable paper trails reduce sanction risk. European companies will pay for that certainty. The Atlantic connection offers predictability amid volatility. When arbitrage opens, Europe prettier than the US, traders charter ships, moving fuel from surplus to deficit and stabilizing supply. When energy supply chains are disrupted and prices spike, a great deal of money changes hands. Follow the trail. There are winners and losers up and down the chain. Ship owners with scarce vessels see earnings soar when routes lengthen. Insurers collect higher premiums for risky voyages. Flexible refineries and traders can switch slates, reroute cargoes, and capture arbitrage. Losers are often end consumers and less flexible importers, who must pay higher spot prices, fueling inflation and squeezing margins. Governments may spend to cushion shocks. Firms locked into inflexible contracts or without hedges are particularly vulnerable. Volatility redistributes wealth toward those controlling assets and optionality. For market participants, the lesson is clear. Flexibility and risk management beat wishful thinking. Build resilient supply chains and use financial tools to hedge price shocks. Diversify suppliers across regions, Atlantic Basin, Middle East, Asia, and Africa, to pivot when one route is stressed. Blend long-term contracts for stability with spot purchases for opportunity. Invest in intelligence, watch ships, outages, and geopolitics to anticipate shifts and pre-position hedges, charters, and inventories. For policymakers, invest in efficient ports and strategic reserves of crude, diesel, and jet to buffer shocks. Provide clear, predictable rules and lead times to enable long-term investment. Keep sea lanes open and build partnerships, including with the US, to reduce choke point risk.